Welcome to the Deep Dive. Today, we're really digging into Ibotta's Q2 2025 earnings call. And this isn't just, running through the numbers.
No, not at all.
It's more about looking at a company that's, facing what their own CEO called a classic innovator's dilemma.
Ah, that's right.
So we're going to try and pull out the key info, the insights, maybe some things hidden beneath the surface, and definitely the market's reaction. It's a critical look at a company in a really fascinating and probably for them, pretty tough transition.
Yeah, fascinating is one word for it. Ibotta, that's IBTA, they released their Q2 numbers after the bell on August 13th.
Yeah.
And the market reaction, it was swift and pretty brutal.
Brutal seems like the right word.
Yeah, a big sell-off. We saw multiple firms downgrading them, slashing price targets, lots of concern clearly about the numbers they reported and maybe even more so the guidance they gave looking forward.
Okay, so let's hit those headline numbers for Q2.
Right.
Revenue came in at $86.0 million.
Right.
Which was actually down 2% year over year and definitely missed what analysts were looking for.
Yeah, short of consensus there.
And GAAP EPS, just $0.08. That feels like a pretty significant miss compared to expectations.
It was. Now, on the non-GAAP side, the adjusted EPS was $0.49. That was, a bit of a mixed bag. Beat one consensus number, missed another one.
Right.
But maybe more telling was the adjusted EBITDA, $17.9 million. That's down a hefty 29% from last year. And you saw margins really tighten up from 29% down to 21%.
Wow, that's quite a squeeze.
It really is. And it signals the heavy lifting they're doing right now, the investment, the friction as they try to re-engineer their whole business model.
But amidst all that financial pressure, there was one operational number that looked pretty good, actually.
The redeemers?
Yeah, total redeemers grew 27% year over year, hit 17.3 million. That's a strong user number.
Yeah, really strong growth there.
However, the flip side was redemptions per redeemer. That was down 21% year over year.
And that contrast, right? More users, but each user redeeming less? That really gets to the heart of the tension here.
Yeah.
The market clearly looked past the redeemer growth and focused hard on the financial misses and that weak guidance. That's why you saw such a sharp negative reaction. It highlights this disconnect between management's big long-term strategic picture and the market wanting to see solid execution right now.
It feels like more than just standard growing pains, doesn't it?
I think so. It speaks volumes about how entrenched the old ways are in CPG marketing and just how fast Ibotta is asking everyone, their clients, the market, to adapt. It's a lot to digest.
So if that's where things stand, what's the bigger story? This really gets us to the core. Their strategic transformation, this is where that innovator's dilemma comes in, and it's pretty interesting.
It is. Management is undertaking this massive pivot. They're shifting Ibotta away from being, just a cashback app, which is how most people probably still think of it,
right,
towards becoming a full-on performance-based marketing platform. And it's built around the specific thing they call cost per incremental dollar, or CPID. Exactly. The big vision, the way they talk about it, is to reinvent how promotions are measured and purchased. The ambition isn't small. They want to break out of just being seen as promotions and tap into those much, much larger digital media budgets that CPG companies spend every year.
So moving from the promotions budget line item to the media budget line item.
Precisely. It's a bold move. If it works, the payoff for shareholders down the road could be significantly higher. They're essentially trying to prove that giving a discount isn't just a cost, it's a measurable way to drive sales like any other media channel.
And you mentioned their CEO, Brian Leach, actually used the term classic innovator's dilemma.
He did, yeah.
Do they stick with what works, keep refining the existing promotions business, or do they go for this really disruptive, potentially much bigger strategy for the long term? They've clearly picked the second path.
Absolutely. Even while acknowledging, that it was going to cause some temporary bumps in the road, it's definitely a high-stakes gamble.
And choosing that path, it immediately brought challenges. They were quite open about these on the call.
Very transparent, yes.
A big setback in Q2 was that two of their initial CPID pilot partners decided not to run more campaigns in the second half of the quarter. That was unexpected.
Yeah, contrary to what Ibotta was hoping for, and certainly what analysts were probably modeling in, that hurt.
You bet. So why the pause? Well, for one client, management said it was basically just waiting on third-party validation for the results they saw in Q1.
Okay.
Now, here's the potentially good news, the silver lining. Ibotta has now received that validation. It came from a major media measurement firm, and apparently it showed the campaign results were even better than Ibotta's own, more conservative calculations.
Oh, interesting. That's actually a huge win for them, potentially.
It could be. It's a crucial proof point they can now take back to that client and others. Big credibility boost.
Right. And the second client, what was the story there?
That delay sounded more like internal complexity. Things like getting internal alignment, figuring out budget allocation. Basically, navigating what management call these complex matrix organizations.
Ah, the big company hurdles.
Exactly. They just can't always move as quickly as we would like, was the quote, I think. It means you've got layers of people, different departments, lots of stakeholders who all need to sign off on something new, like CPID.
Yeah, trying to shift a decades-old paradigm, as they put it, in how CPGs think about promotions.
Yeah.
That's not easy. It turns a quick pilot into, well, a bureaucratic slog sometimes.
So to tackle these issues and just get better at selling and delivering this new CPID model, their whole go-to-market, Ibotta's doing a pretty significant sales reorganization. They're moving away from the old territory-based setup. Instead, they're creating teams focused on industry subverticals. So you'll have teams for food, beverage, health and beauty, household, and general merchandise.
That makes sense. It aligns them more with how digital media's sales teams usually operate.
Right. And importantly, they said they've cut down the number of accounts each enterprise seller handles. The idea is to let them be more consultative, really spend time educating clients on CPID.
Which sounds necessary, but those kinds of changes, they always cause some disruption in the short term, don't they?
For sure. They acknowledge that, disruption, even some turnover. They mentioned that historically, when accounts get handed off to a new sales rep, they tend to see about 16% lower revenue growth initially.
Oof.
And they said many of their top 50 clients will actually have new reps by Q4. That's a lot of relationship rebuilding needed right when they're trying to sell a complex new product.
Yeah, tough timing. But they are bringing in new leadership to help manage this, right?
They are. Some key hires announced just after the quarter ended. Matt Puckett is coming in as the new CFO from VF Corporation, starts August 25th.
Okay.
Then there's David Parisi joining as SVP of Enterprise Sales, and he comes from Twitter. Christopher Boyd is the new SVP of Business Marketing from Seeker, and Andrew Allman, SVP of Sales Operations from LinkedIn.
So you see a clear theme there. Digital media, sales execution experience. That's exactly the kind of talent they need for this pivot.
Exactly. Now, despite all these challenges and the market's negative view right now, there were some positive developments we shouldn't ignore.
Right, like that third-party validation we mentioned. That's actually huge.
Absolutely. Having independent proof that their measurement works, especially showing real-time incrementality, that's gold when you're talking to skeptical CPGs.
It builds trust. What else?
Management also said they're getting more access to higher-level decision makers at key clients. That suggests the CPID message, the strategic vision, is resonating higher up. They're having talks about bigger, more strategic investments, not just, one-off tests.
Okay, that's encouraging. And the publisher side.
That was definitely called out as a bright spot. They highlighted deeper integrations with Walmart, things like using your phone number at checkout to link offers, and making the manufacturer offers more visible in the Walmart app.
And DoorDash too, right?
Yeah, rolling out offers to most DoorDash customers in Q2. That certainly helped drive that overall redeemer growth we saw.
Okay, so that explains some of the user growth. But it also ties back to why redemptions per user went down, doesn't it?
Exactly. It's a mix shift. You get more users through these third-party platforms like Walmart and DoorDash, which is great for reach. But maybe those users aren't quite as engaged or don't redeem as often as the core users who downloaded the Ibotta app directly. So average redemption per user dips.
It makes sense. It's also worth remembering the backdrop here, the economy.
Yeah, that's definitely playing a role. Management was blunt. The current macro environment is not helping.
Right.
Some big CPG clients are apparently pausing or just tightening their belts on promotional spending. Why? Economic uncertainty, maybe tariffs, the political climate. It's a cautious time for consumers, and so it's cautious for corporations too.
And in that kind of environment, CPGs demand even more proof that their marketing dollars are working right. They want rigorous measurement, clear ROI, especially for things like promotions that might have been seen as more discretionary spending before.
Which, ironically, plays right into Ibotta's hands with CPID. Their whole pitch is about providing that ROI measurement.
It is. But even with a strong pitch, if companies are just generally cautious about spending anything right now, it still creates a hurdle for adoption, even if the value proposition is clear.
So looking ahead, how does this all translate into their guidance for Q3?
Well, it reflects these short-term headwinds pretty clearly. They're guiding Q3 revenue to between $79 million and $84 million. At the midpoint, that's a pretty steep 17% drop year over year.
Oh, okay, 17% down. And EBITDA.
Adjusted EBITDA guidance is $9.5 million to $13.5 million. That puts the margin at roughly 14% at the midpoint, so significantly lower than Q2's 21%.
So very conservative guidance.
Extremely. They're fully baking in the struggles with scaling up these new performance marketing clients, plus the ongoing disruption from the sales reorganization. And importantly, they said this guidance assumes no new performance marketing campaigns kick off unless they're basically already signed and running.
They're not counting any chickens before they hatch.
Not at all. Now, the long-term view is where management tries to paint a brighter picture, but it's also where you see the market's impatience.
Right. What's the timeline they're suggesting?
They think scaling this new CPID model might take anywhere from 9 to 12 months per client.
Per client. Okay, that's a long sales and implementation cycle.
It is. It suggests the impact on revenue growth will be staggered. Significant acceleration might not really show up until, say, 2027 or maybe even later, depending on how quickly they can onboard clients at scale.
And they're planning to keep spending heavily to get there.
Yes. Continued heavy investment in R&D over the next 12 to 18 months. Things like the core technology, internal systems to support the sales process, tools for clients. It's a long-term investment phase.
So putting it all together for investors, you really see this stark disconnect, don't you?
Absolutely. Management's talking about this bold, visionary, long-term strategy shift.
Right.
But the market's reaction is laser-focused on the immediate problems, the execution stumbles, the delays in getting CPID ramped up.
Analysts basically flagged the slow CPID adoption, the sales team disruption, those pilot pauses. Those were the killer points for the stock.
Exactly. It's that classic clash. Wall Street wanting results this quarter versus a company trying to build something fundamentally new for the long haul.
But if you step back, the strategic idea still sounds pretty powerful, doesn't it?
It really does. Trying to grab a piece of those huge media budgets by proving promotions deliver measurable ROI makes a ton of sense. And the technology, that real-time incrementality measurement, especially now with the third-party validation, that is innovative.
Yeah, they seem to be building something genuinely different in a space CPG marketing measurement that desperately needs better tools.
So what we're seeing now is really transition pain. It's the volatility, the uncertainty that comes when a company tries to make such a massive change to its core business.
What should people be watching for in the near term? What are the key catalysts?
I think you need to watch. Can they successfully convert those CPID pilots into full-blown scaled campaigns? How effective is this reorganized sales team going to be at actually closing new deals? And do they keep adding and deepening those publisher integrations? Those are the proof points the market needs to see.
Okay. So for our listeners who like to think about potential market moves, let's shift gears a bit. It's time for our outrageous but plausible trade idea.
All right.
And let me stress, loud and clear, this is purely for informational and entertainment purposes. It's absolutely not financial advice. Please always do your own research.
Definitely not advice, just a thought experiment.
Exactly. So think about Ibotta's stock price right now. It's taken a real beating.
Yeah, heavily punished.
What if?
Yeah.
What if that makes them an attractive, maybe even a digestible acquisition target for a major CPG company?
Interesting angle.
Think about a giant like Procter Gamble or Unilever, maybe a Coca-Cola. These companies have absolutely massive marketing budgets, billions of dollars, and they are constantly looking for ways to make that spend more effective, more measurable, drive actual sales, build loyalty.
And Ibotta's CPID model, especially with that third-party stamp of approval now, theoretically offers exactly that, doesn't it?
It seems to. The current market cap, after this drop, might look pretty reasonable to a CPG giant. And they wouldn't just be buying a cashback app anymore. They'd be buying this proprietary, potentially industry-first tool to measure promotion effectiveness and drive incremental sales, almost in real time.
An acquirer could potentially embed that capability right into their marketing operations, turn promotional spending from this kind of fuzzy cost center into a really efficient, highly attributable way to boost the top line.
The strategic value, especially as everyone in the CPG world gets pushed towards more measurable ROI, that value could arguably be way higher than Ibotta's current stock price reflects. It's like buying a key piece of the future of CPG marketing.
It's a bet on a paradigm shift, essentially.
So here's the outrageous but plausible trade idea. A long position on Ibotta, IBTA, Maybe you hedge it with a short position on a basket of traditional CPG advertising agencies.
Okay, explain the hedge.
The thinking is, the old school advertising models, the ones that aren't as directly tied to measurable sales outcomes, they're going to struggle more and more as clients demand the kind of performance-driven, ROI-focused spending that Ibotta represents with CPID.
So as Ibotta potentially disrupts, the traditional players get squeezed.
Right. And eventually, maybe the pressure gets so high or the opportunity looks so good that one of these huge CPG players just decides to buy Ibotta outright to secure that capability and leapfrog competitors. It's a bet on the inevitability of this digital measurable transformation hitting CPG marketing hard. And Ibotta, despite all these growing pains, seems to be right at the forefront of that change.
Interesting thesis. But again, just to hammer it home, this is purely speculative, informational purposes only.
Absolutely. Now, not financial advice. Do your own homework.
Always.
So, to wrap things up then, Ibotta is clearly going through a really challenging period, but it's also potentially transformative. They're making this huge shift to a performance-based marketing model.
Right. The near-term numbers, the guidance, they've definitely disappointed the market, hence the stock drop. But the company is making fundamental changes, sales team, product focus. It's a deliberate, if painful, pivot.
And the success of it all really boils down to whether they can get widespread adoption for this new CPID model.
Yeah.
Can they turn the pilot interest they have now into real, scalable, recurring revenue?
That's the multi-million-dollar question. The path ahead looks long, and as Q2 showed, it's got plenty of immediate hurdles. But the potential reward, if they can actually pull off this massive change, it could be substantial. It really is a test case of an innovator trying to disrupt itself.
So what stands out to you after hearing this deep dive on Ibotta? Maybe think about this. How could this kind of shift towards measurable performance impact all marketing spend in the future, not just promotions? We'd love to hear your thoughts. Thanks for tuning in to The Deep Dive.